Good afternoon, everybody. It is a pleasure to have today the visit of GESIURIS and their fund, Japan Deep Value. It's a very interesting product, and it's quite infrequent in Spain. It's a real privilege for us to have Luis Torras and Marc Garrigasait here with us today. They are both in charge of this fund, and they're going to tell us a lot about their fund, and later on we will open the floor for a Q&A session. We will give them 20 minutes to do their presentation, and then we will open the floor and ask whatever comes to mind. First, please allow me 1 minute to bid you a warm welcome and to thank Gonzalo, Andrés, and Paco and the Cobas team for their trust and for allowing us to be here in such a great venue to present to you who we are and the products that we deal with. The first thing that I would like to do, just to set a backdrop for the messages that Marc will deliver later on, our idea is to do a brief presentation. Firstly, we'll talk to you about Japan Deep Value, and as they do with bonsais, what we're going to do is to get rid of accessory items and give you just 4 or 5 brushstrokes to describe what we do. But before we delve deeper into the presentation, I would like to highlight what Andrés already said. We are part of the management company GESIURIS, and we have 3 vehicles, the SICAP, GESCAPO, which is our idea lab, and then we have 2 investment funds. One does global investments in variable income, agriculture and water, and then we will delve deeper into Japan Deep Value that was launched in August 2016 that invests in small and micro caps in Japan. Before I give the floor to Marc, who's the manager of our fund and who will explain to you the metrics and the way we do our valuations, what the fund is all about, and so on. Okay, thank you, Gonzalo. Well, just to set a framework for the messages and to facilitate what Marc will explain later on, I would just like to say that we have never used one label or another to classify ourselves as investors. But when we're trying to put together the presentation, we come up with 3 recurrent pillars that define what it means for us to invest with common sense and with success. First, we need to have a good valuation, and we need to adequately judge the price of things. And in order to do that, we need to get closer to value. We know that this approach is always imperfect, but it's one of our great accesses. Once we know the valuation is right, then we talk about the quality of the asset. This is indeed an art. You never know completely because there's many variables at play.
Y por último, y no por esto menos importante, está todo lo referente a la psicología del inversor, que además sabéis que desde que se...
All companies have, of course, peculiar traits, but last but not least, we need to talk about everything that pertains to the psychology of investors. Ever since Richard Thaler got the Nobel Prize this year, this is a topic that has become quite trending. And here we always focus on 2 aspects. We have the manager's psychology, and at the end of the day, we consider that it's part of our trade to know the difference between value and price. Price is volatile, but not value. And this is something that we need to be very well acquainted with. We need to keep our direction whenever the seas are troubled. But here we also need to take into account investor psychology. Basically, I could summarize this into 1 single sentence, which is to be long-term oriented. First, reflecting. Secondly, knowing how to select and configure an investment portfolio, and then being reassured and having grit, knowing how to keep your direction for the long term. So I'm not going to digress anymore. I will just give the floor to Marc directly.
Disculpad, vamos a empezar a hablar, ¿se oye bien? De Benjamin Graham, luego veremos por qué tiene tanta relación. En el año 32, Benjamin Graham.
We're going to start talking about Benjamin Graham, and later on we'll see what the relationship is. In the year 1932, Benjamin Graham published an article in Forbes. It wasn't based on one of his studies, it was a study from Columbia School. Because we all are acquainted with the crack of 29. It's the initial drop that we see here. Actually, I'm going to point it with the pointer right there. Let's see if I can get it to work. Well, in the crack of the year 1929, they experienced a one-day sharp fall. But this fall had an impact for over 2 years. In the year 32, Columbia School carried out a study about the 600 listed companies in the US. 200 of them were listed below their liquid value in their balance, and about 100 out of them were listed below their cash. So this is the cheapest time in the history of the last century. As we will see later on, this is what we have also come across, not in the market as a whole, because this was madness, this was the Great Depression, but we have found this in over 200 Japanese companies. How do we carry out our analysis, or what do we value the most? Basically, we use 3 types of ratios. The basic ratio is this one right here, which is the adjusted enterprise value over free cash flow. Then we always use ROICs, some others call them ROCs, depending on your approach. But then we use a method, which is a GARP type of method, growth and reasonable price. That's to say, a company that's perhaps not so cheap as one that's listed 5 times, but it experiences a 15% annual growth. So we do our ratios, and these are the 3 variables. This is the first one. This is what is in the stock market. You subtract debt and you take into account the cash flow. But in Japan, we introduce another element which is quite unique, which is holdings in listed companies. In Japan, all companies have on average about 15 or 10% of investment in other companies, and the market value is about 10-15% capitalization. So in the Japanese market, we add this as if it were free cash flow, because it's a liquid value. So we calculate the current value and we add it, rather we subtract it to the enterprise value, because it's as if it were free cash flow. We add leasings, because in Japan there aren't all that many leasings, but then we subtract deficits from pension funds, because all Japanese companies are very social. Social aspects are prevalent in Spain, so companies act as if they were the state and they pay for the pensions of workers. And it's nothing too high, it's about 2 to 5% of their capitalization. And therefore, the enterprise value is the numerator and the free cash flow is the denominator. It's the operational cash flow minus the capex. What's the ratio that we normally see in the American market? Well, at first sight, we say this because nobody ever publishes this, but we consider that over 20 times this ratio is a very demanding ratio. And 20 or 30 times this ratio is too much. It's at the limit. And we considered that the average in Standard & Poor's, this doesn't apply to banks, of course, but it's 41, 42 times. So it's something unprecedented. In Spain, the portfolio that we created the first day of the fund in August last year, the ratio was 2. And 2 would be around here, right? Here we have 15 times, 10 times, 5 times would be down here. But because the portfolio since October has increased to 50%, now we are at 4 times. And in the US, the Standard & Poor's average is 40 times. Why do we find this in Japan? We have been asking this question ourselves for 4 or 5 years, but now we question ourselves even more often because we now consider why we have come to understand why they are so cheap. Japan is very different because it's a very complex country. But obviously, this seems like Bitcoin. And because in Nikkei, because this happened in the 80s, and maybe you were too young and you may not remember, but this is like Bitcoin. It's like the 21st century bubble. Those of us who are more aged, we remember that this was just a real estate bubble. It wasn't a stock bubble exclusively. And please remember that the park of the Emperor of Japan, if you go to Tokyo, you can visit the palace of the Emperor, and there's a very big park. And the square meter, the price per square meter of that park was worth more than California as a whole. This was madness, and it occurred in 1989. And it started falling at that point, and it hasn't stopped falling ever since then. And what happened then? All banks, all insurance companies went bankrupt. All banks have mergers, and they have had capital enlargement, so the capital increases. So over 30 years down the road, they're still in a depression. Wages have decreased in nominal terms for many years, and additionally, there's been a big private deleveraging, and that has been offset by public leveraging, as it's happening in Spain. So, in order for something very cheap to happen, there needs to be a very big crisis, a very big recession. That's the first ingredient that you need for this to happen. But why do we also think that this has fallen so much? Because this stock market has been falling for so long, many brokers have disappeared. So there's about 42% of companies that have no broker monitoring whatsoever. 42% of top bigs. In small caps, it's about 90%. So in Standard & Poor's, it's about 6%, the average. There's only 6% of companies in Standard & Poor's that are not followed by brokers that provide reports or recommendations. And we're talking about Japanese reporters. We're not talking about English-speaking reporters here. 99% or 95% of our stocks in our portfolio are not followed by any English-speaking brokers. Luis always likes to talk about speleology. When you're an speleologist, you go down into the cave, you get to a point where people have already gotten, and you don't go deeper because it's much darker. But this is what we've done. But what we've done is to find cheap companies with Japanese information, and nobody went deeper than that. So we consider, okay, why don't we go deeper? It may be possible that we find a treasure that no one has ever come across. So after so many years in recession, deleveraging, seeing companies that have ceased to invest, we have seen companies that, by the way, 50% of companies in Japan have net cash. 50%, that's amazing. In the United States, it's impossible to find this. Well, possibly techs do this, but 1/3 are listed below the accounting value price. ROEs are very low. That's another criticism that we often see in Japan because they're so conservative that they don't leverage. They have a lot of money put aside. ROEs are very low, and they pay off dividends because in Japan, we normally say that just like in the United States, consumer is in command, and in Europe is civil servants who are in command. But in Japan, great corporations, large corporates are in command. They're the core of the country, so they're paying dividends there. And in a way, that's like taking in the results from workers and giving it to shareholders. So there's very little dividends. In our portfolio, we pay a 2% dividend rate with a very low free flow. That means that they could pay 20% or 30% if they wanted to. We don't think this is going to change, nevertheless. Dividends are increases, and buybacks of stocks, of shares are also increasing. But this could be a trigger. But the question is, what trigger could there be? so that this has a positive impact on companies. But anyhow, we came across 200 or 300 companies that were incredibly cheap, affordable. And in August, we selected 38 exactly. Those 38 have been maintained, unchanged, until 2 months ago. We have introduced 4 more positions. There was an exit because there was a takeover bid, and I'll explain that. We didn't like it. It was a negative experience. They paid 40%. It's been a scandal for us, but it could happen. It could happen. It may happen that they pay less than it's worth for it. But the portfolio, just for you to get an overall idea, for you to get a flavor, it's mostly micro caps, and 45% is small caps, which are above 300 million. Only 6% amount to more than 2 million in capitalization. But let us not forget that capitalization is ridiculously low. This company that has 200 million capitalization in Japan, the same company in the US could be at 1.1 billion perhaps. So actually they're bigger than they seem. The average in the portfolio has a history of 68 years. So the average of the portfolio is composed by companies that are 68 years old. So they're centenary companies, many of them. We have tech companies that have been created in the last 20 years, of course. And obviously, because these companies are not very well known, 80% of them sell to Japan exclusively, and 20% to exports. Industries vary. Automotive, supermarkets, foods, building, engineering. We have come across amazing companies in the building sector that have no debt whatsoever. And when we saw that we came across companies in all industries, we were fully convinced that there was something impressive there. This is not a sector that was too cheap, and it was not unique for a sector. All sectors were quite affordable. So we put together the portfolio with 38 stocks with no rotation, no turnover, and now we have, of course, increased some of them because the fund is increasing, and the margin that we have is actually amazing. I'm going to set a couple of examples, and by the way, these are examples from when we started. We have companies that are the top 5s in the portfolio. Maruzen, they manufacture kitchen appliances or machinery for restaurants and so on. When we purchased it, it was $195 million. It had in cash 17 million, 5 in leasing commitments, holdings of 28, and deficit of 16. So actually you were paying for the company 18 million, and in the last year it generated 24.5 million. So you are paying 1 times the free cash flow. The other one is Tokohu Shinsha. They paid us for purchasing it because the adjusted value company was minus 29. They paid us 30 million for purchasing it. It's true that it's a company that is in the average sector. It's not a very beautiful industry, actually. It's the production company that created the movie Lost in Translation. And it had a negative free cash flow. It generated $23 million. And this was a bad year. Why am I showing these two? Because the first one has increased 100% since we purchased it, and the second one has increased by 10-20%. And the second one has published weak results in the last few years, but there was no trigger, no catalyzer for them to react. But the first one started increasing. And if you want, Andrés, we can explain the experience that we've had with this company. It's been very interesting. It was something that we didn't understand, actually, for a month and a half. We're trying to wrap our heads around it, and because we couldn't believe it, we couldn't believe it. And it was just the way it was, and we increased the weight that it had on the portfolio. Well, and this is the story since it started, actually. The increase has been 50% for the portfolio since the 15th of August last year. And we started talking about Graham, but now we're going to wrap up talking about Warren Buffett. He explained something very similar in Korea in 2004. Actually, there's one person present here in this room who called us up when we put together the fund, and they called us up and he said, Marc, don't you remember that Warren Buffett explained this in his letter? And we didn't remember it. And we found the letter, and that's what he described. He said, in 2004, in 4 hours, I found a couple of companies, 3 or 4 companies that you were paying for them 1 or 2 times what they produced in 1 year. And they multiplied their output in 4 or 5 years. And we have never come across something so affordable ever in our team, but it does happen sometimes. It normally has to happen in a faraway market that is not very well known and where things are going on for people not to invest. And by the way, this is a typewriter, a Japanese typewriter, that goes to illustrate the complexity of the market. Luis has an MBA in Tsinghua University in China. This is the university where the Prime Minister and the President of China studied. And he always says, China is complicated, but now that I'm acquainted with Japan, I can say that Japan is even more complicated. Just imagine how complex it is to use this typewriter. So this mirrors the complexity of Japan. But when they ask us about why we went into something that we were not so acquainted with as, for instance, European companies. Well, the answer is for this type of companies in Europe, you would be paying 40, 50 times, but here we're paying 2 times. We don't have a lot of information about products sometimes, and we think that not being Japanese has helped us see that it's cheap, because we talked to Japanese people and they didn't consider that their companies were so cheap, but we compared it with American and European companies and we thought that this was unthinkable how affordable they were. So not being Japanese has helped us had an external perspective, and therefore it has helped us put together this fund. Thank you very much. Actually, I have many questions because we're starting to take a look at Japan, where we find very interesting companies, but we're also finding many problems and many difficulties as the ones that you have described. So perhaps the first question that I should ask is based on my previous experience. I've been to countries such as Korea. It's very similar to Japan. It's very affordable, but it's always been affordable. Or for instance, in Russia, you know that the situation is quite similar. There's petrol companies that have 20 million in cash in their balance sheet, and no one really knows what's going to happen. So these are companies that have always been cheap. They have always been affordable. So the first question that comes to mind is, whenever there are so many affordable companies, how do you select one? How do you differentiate one from another? Because the same company could be cheap for 10 years, so you need to select the one that is about to change. Is it macro or is it micro? Well, that's a difficult question. Obviously, the key is the following. When we analyze the P&L, the results on Reuters or wherever, we did our calculations. Then we contrasted it with the annual report, and we saw that this was normally in Japan. We were investing for 4 years in Japan with very few positions, and we thought that was unbelievable that they were so cheap. But then we invested, and we had to believe it. The 4th year after investing, we saw an increase in our stocks, and they were still very cheap, but we decided to start translating the reports from English from Japanese to English, because the translation task was easier, and figures are normally reported in English, so it made it easier for us. And we started to see triggers and catalyzers, and It's actually impossible to think that one company is going to have one trigger and another company is not going to suffer its effect, but we managed to differentiate it. And it happens with Japanese companies that their executives are about 60, 70 years of age. And a 30-year recession means that they have lived all their professional life in recession. We consider that whenever the generational replacement happens, it will change. Actually, there was a company whose chairman retired, and they started experiencing amazing growth just as the chairman was replaced. Normally, this type of companies, they don't want to pay out dividends. They don't want to do anything drastic because they think that the recession is going to hit them harder. So we really focus on family companies too. But there is one case in which one stands out. There's one company that's not family owned and that has experienced the largest increase in the portfolio, and it's the only one that has no control by families or by associations in the industry or by the employees. So we consider that the freer the companies are, the higher the potential is for them. So in Japan, there aren't takeover bids. Normally, there are very few mergers and acquisitions because it's very aggressive in Japan to buy a competitor. So we don't really think that the growth is going to come from takeover bids. Well, we've had 2 takeover bids. One just happened before we started, so we didn't really suffer the effect. So we always try to monitor this. Actually, we always write down in the report the age of the chairman. This is a key variable. But quite honestly, we are currently trying to find unique aspects. We're very diversified. We are not in a hurry. What we do is to purchase and maintain because the stocks are, because it's very easy to do this type of investment in Japan. What you have to do is to purchase, to keep, and to see when the trigger happens. So there's many companies that are cheap, and what you try to do is to filter out the ones that are not under anyone's control so that there is no interference, but also on the other hand they need to be the best in class, they're best in their industry because everything is organic. You cannot wait for acquisitions, so they need to be the winners, they need to be the leaders in the industry. That's right. What we're trying to do is to find companies that are acquiring others. We call them compounders. We try to see whether there's someone smart who is a compounder who purchases other companies at the current price, which is ridiculous, and creates some sort of galactic company. But we only have one company that did a takeover bid over one supermarket company, so for the time being they haven't done any acquisitions. We consider it's because it was the next door supermarket. Perhaps that's the reason. Or let's see if it goes beyond that, and let's see if there's some sort of additional element of this kind. But we are trying to research that. Just to wrap up that point, so you're crystal clear about the fact that this is not a value trap, right? Because for 30 years we've been talking about this, but is there anything specific that you can point out, something that is a clear change compared to what happened in previous times? Well, this is full of value traps, actually. It's very dangerous. We're not saying that you need to invest in Nikkei and that's it and that's all. There's many value traps. Companies such as Toshiba are a disaster. They're a conglomerate. Actually, this comes from a time when samurais lost their rights and they got granted the right to produce one good or trade, and keijetsus are very vicious because they have created monopolies, and we don't like large conglomerates in Japan. When something goes wrong in Japan, it's very difficult for them to change it. So if that company is not doing well, do not invest in it in Japan, because in Europe or the US, they would do a change, but this is not what's going to happen in Japan. We are very afraid of companies that experience drop in sales, because in Japan, many of the companies that we selected had drops in sales, and that's very dangerous. And because we have so many to choose from, we can choose the ones that had experienced increases in sales, even though the growth could be 3 or 4% increase in a year in Japan, and that's very high. And the the average ROI needs to be 18%. We try to detect growing ROIs. So if the average this year is above what they had in the last 5 years, that means that the company is doing well. So we're trying to find those that have ROICs that increase and also sales that increase, so that we can avoid value traps and to select the cheapest in the sector, of course. Another question, changing perhaps the angle. You have many microcaps, taking into account that Japan is very far away and it's a very complex company in the corporate and the social sense too. And you're talking about microcaps where there's nothing previously described about this. Wasn't it enough to do small caps or mid caps? Well, it could have been, but we said, okay, since we found value, let's go down this cave the most we can. And now that we are doing it, we see that there's a very high value. Being microcaps, they are very unique, but they're 100 or 200 million. And as I said before, this equals a US or a European company worth 500 or 600 million. They're very ancient companies. These are companies that can be very reassuring, but they're obviously microcaps. And we didn't establish any lower limits. Well, less than $100 million in capitalization, that's our minimum for investing. But we considered that since we were going deep, we will go the deepest and try to find the ones that we actually like. So what's your edge in Japan? Why are you better than Pilakman, for instance, or Sony? Well, that was complicated, but there's many people who go to Japan and they try things out with very large teams, with lawyers and so on. Well, but activism is not applicable in Japan. I think Bill Ackman was the one who explained that his activism in Japan has been the lightest thing that he's ever done, because in Japan they came with sentences that were very politically correct and doing their best attempt. But I don't think activism works in Japan, especially if you're a foreigner. So what's your niche? What's your edge? Well, be in value. And we found that in Japan they use a lot of technical analysis. They've been following for 30 years. So who does value? Who purchases and keeps? So they do a lot of technical evaluation, and they're very short-term operations. And it seemed like it was going to pick up many times, and it hasn't been the right time. So in Japan, there are not really value spores. There are activists, Ifigo, Asset Management. Both of them are very activist-like. And then we have DFM Value. Later on, we can talk further about this, if you will. They've been there for quite a few years, but in reality, there is no value fund money invested there. There aren't people investing there. If you go to France, who can find an interesting company? Because there's so many value managers that go to France, from Spain, from Germany. The large hedge funds like Bill Ackman, they invest in the large ones and not in the small ones. And we're fortunate because we're small, and because we're small, we can go to a fund where Goldman Sachs cannot invest. Just to add to what you said, I think at the team level there are two aspects that are complementary to what Marc said. First, the analogies that Marc explained about Benjamin Graham help us a lot to understand where we're placed in the map, and also allocating our available time well. We don't really try to break down something that is very complex, but what we do is to work on what we know to do well. For instance, analyzing the balance, seeing that the downside risk is completely hedged for, and we have some anchor points that we know are solid. And apart from that, we also do what Marc said. There is a very high inflation. And with risk management, paradoxically, in spite of the distance that you have just discussed, Marc, correct me if I'm wrong, but I don't think we've ever had such certainty as we do here in risk management. Because of what you said. You need to give up understanding the company better. Management won't meet with you. You're a foreigner. They don't normally speak English. And they told us, listen, don't try to get close to them because they don't have investor relations. For instance, Fanuc, they had US activism, and Fanuc is a very large company. They started with investor relations because there was this American, I don't know if it was Bill Ackman, he started doing activism then, and he caused them to establish an investor relations team that didn't have Fanuc, and it's at 20 times, right? They're very good, so that's your hope. Yes, it is. Another question, maybe we have already asked about it from another angle, but are there some sort of caveats, some sort of obstacles that would make a company that's not worth investing in? You've talked about requirements such as, for instance, increase in sales and so on, but is there a red light that whenever you see it, you say, okay, this is a no-go? Well, we have been considering whether if it's part of a conglomerate, then we don't buy it. We have had a takeover bid that we got 40%. By the way, we had purchased 9 months before. It was a bad operation. It was a disaster because the company had presented results and we bought it at 4 times. It increased by 40% after the takeover bid, and it was listed at twice the free cash flow because their results were spectacular. It was a Bayashi Group. It was Bayashi Road, and it was bought by Bayashi Group. So maybe we will rule out all those that are part of conglomerates, issues. In the Japanese stock market, 9% of companies are holding and 14% are investees of those holdings. 14% of all the stock market. So it's full of investee companies. So if we had had this takeover bid in 3 years, it would have been a disaster, a total disaster. 40% in 9 months is not bad. But if we had taken them 3 more years, we couldn't have invested in others. So we need to think about this, and that gives us more certainty. And whenever we start to translate, we always try to find hidden liabilities because we thought we were going to find dirty audits or reports or some sort of risk related to a trial that they had lost and they had to pay liabilities. But what we found was hidden liabilities, which were pension funds. And the other 2 aspects that we've seen is holdings. We've seen that they have investments in other Japanese companies that are always providers or customers. And they are so transparent that in the annual report, they always explain that they have purchased stocks from their provider to improve their relationships with them. So sometimes they own 1,000 stocks in order to say, okay, I'm your shareholder. And sometimes they own 3% of stocks of their providers. And you don't avoid that. No, we don't, because otherwise we couldn't invest, because that's the way all of them are. So the last asset that we found, and we actually haven't measured it because it's in the security margin. All of them have paid for real estate assets. Their headquarters, buildings, warehouses. So we haven't really measured that too much. But in each annual report, you see the square meters of each asset. So every time we go to a ratio of 2 times, which is now 4 times, we don't include what the worth of the real estate assets in the portfolio are. All these things that Marc is talking about, exchanging stocks as if you were exchanging cards, is something that you need to consider from the perspective that in the US they have a 20 trillion economy and they have 12,000 listed companies, but in Japan they have 3,500, and they're 1/3 of the size. This is like having a company audited here in Spain. It's a sign of strength, transparency, and so on. And when Marc was describing the exchange of stocks between providers, this is another proof of trust for them. And this is what has also given rise to this opportunity, because it's a very deep market. Just imagine an economy that is 1/4 of the US economy with the same amount of listed companies, and in Spain we would be about 150 compared to the 3,500 that they have in Japan. Are there any mistakes that you have made, or perhaps you have already brought them up? These are all the things that you avoid, and they possibly stem from some mistake. But are there any lessons that you would like to forget, or not forget, but experiences that were a bit difficult? Well, we have done very positive discoveries. But would you like to explain the anecdote about Maruzen? Actually, we have been carrying out deep investments for 14, 15 months. We have been looking at it from afar for many years, and we've taken a closer look for 2 or 3 years, but we see many positive aspects. We are increasingly more aware of the fact that it's very complex and very difficult to work in Japan. And as we've seen, the company always will have a social edge. So it will be very difficult for them to pay out dividends and do stock buybacks. And it's very difficult for the company to change until the people in command do not retire, for a catalyzer or a trigger to come up. In Maruzen, this position is a position that we acquired at 800 or 900 yuans. And when it was 1,400, we received a letter from the depositor, and there was an offer that was 1,200. So it was 200 yens below its listed price. We thought it was a mistake, so we talked to Nomura in this case, and we said, listen, do you know what's going on here? Because we just received this letter, we just received an offer below the listed price. So it was very difficult for us to understand. And we spent 1 month just to find out what was going on. In a European or American company, you would know what was going on because you would have the leaflet. So we had to translate the leaflet. And apparently, Mr. Watanabe, they have 40% of stocks of Maruzen, and he was going to retire. And because he was going to retire, he considered that it wasn't admissible that he would take his stocks home. So out of the 40% owned by him and his family, 10% was given to the company at 1,200 yens. When he was listed at 1,400, and when we saw that, we started buying like crazy. We started buying at 1,500, and now the company owns 10% of the 10% further of the portfolio bought at 1,200. That has been given out to all the shareholders, and this is similar to Nakano refrigerators. They're very boring. Most of our companies are very boring, except for some technologicals and some video game companies. These are the providers for 7-Eleven, right? Yes, they are. So they manufacture their refrigerators for 7-Eleven in China and Japan. I don't think they do in Malaysia. I don't know why they don't. But the same happened. The chairman retired, the operation was the same, and here, once again, we increased our operation, and Nakano refrigerators has in its value 40% of its stocks purchased at a very low price, and they don't have the obligation to amortize them. They do it slowly but surely, but currently they keep them in the portfolio. And the enterprise value is negative for Nakano. So that's one of the 5 or 6 examples among the 40 that we have in which we were paid to buy. A more general question. We don't have much more time left. If we want to hear questions from the internet, please stop me. But we have some more points I would like to bring up. So how do you build your portfolio? How do you allocate the weights to different companies? Or does this have to do with risk or upside? How do you think about it? Well, first we do a bottom-up approach because we want the best ones. We want the lowest free cash flows, higher ROICs or growing ROICs, and increasing sales. So this is pure bottom-up. So we did that analysis. We got about 200. And out of those 200, we selected 50. Obviously, we allocated them between sectors so that we wouldn't concentrate too much in one sector. So the maximum that we have in one sector is 20%. In the supermarket industry, we have 20%. In the building industry, 20%. And in the automotive industry, we also have 20%. We have many Toyota subsidiaries and Subaru, etc. So At the end of the day, our approach is bottom-up, but obviously we cannot have 50% of the building sector in our portfolio because obviously we wouldn't like that. So the difficult question would be that if they're the cheapest in the company, in the sector, would we allocate more weight? Yes, but maximum 30, never 50%. Could we say that there is a sectorial factor that creates a sector that is cheaper than expected? Well, not really. We have now found 200 extra companies. We constantly find hidden treasures. So we found 200 new companies, and we've realized that 40% of the very cheap companies are in the building sector, in the construction sector. And we are seeing that construction is cheaper than any other sector. This is the first time that we have detected this. But what confirmed this approach, and when we decided that we were no longer afraid of investing, was when we translated everything and we saw that this was multi-sector. These were certain size of companies. They had no English information and no one followed them. So this was the reason why they weren't being followed and why it was worth investing in them. An indiscreet question, because since you're here, we cannot let you go. So this is a very difficult task. You have to translate a lot, and obviously this comes with costs that a normal fund wouldn't have. So can you talk about the type of fees that a fund like this would deserve? Well, in the beginning, we thought that we should have a variable fee on results. Obviously, we thought that was the way that we were going to make more money, obviously. We were supported in the launch by very few customers. They helped us launch it. And we told them, we said, listen, maybe we could have a variable commission or a variable fee, but we're going to make much more money. And they were fully convinced very soon that the fee should be fixed. So we have a 1.5 management fee. And of course, we devote a lot of time to this, and there's no turnaround and there's no rotation. So once we discover the companies, there's less work to do than with other portfolios. So there's a double side to it. On the one hand side, it needs to be more expensive, but on the other side, it isn't. So the fixed fee is 1.5. We don't want to be too ambitious. We want things to go well, to have happy customers, and for it to help us place ourselves on the map. And what's your sales policy? In other words, do you have a long-term horizon? I think this is what you include in the presentation, 5 years or something like that. So what's the potential for each company? How long do you wait for a company to reach its potential? You earlier on were talking about the opportunity that comes with a company that can be purchased by only 40%. Andrés, as you very well know, the most difficult thing in our job is to sell. Finding cheap things is not so difficult, but selling is very difficult. So we're trying to consider selling some of them because this has gone. This company that I mentioned earlier was 1,800, and now it's at 6,000, and the weight is about 1%. We cannot maintain it for now. In the beginning, it was an excellent company. It's listed at 24 times, and the sales multiples are 15%, and the ROIC is 20 times. And after increasing to 6,000, these are the ratios. So we maintain it, even though it's not so cheap as it used to be. But we are trying to consider whether we should reduce our presence in some companies to purchase others. We're doing another search wave with 200 companies. We have started carrying out deep analysis on 10 companies, and out of those 10 that we have investigated, we have invested in 4. We consider that we can find another 30 or 40, and this would be more fuel to substitute others and to add to the fund, because the fund is increasing in volume and it therefore is good to increase the portfolio. Therefore, we think that companies should yield 20% on an annual base in the next 4 or 5 years. We never have so much of a certain opinion about a fund, but in this case, we're completely certain. For instance, how good does a new company need to be to replace an old one? Taking into account that they're small, that they're liquid, and you need to, of course, set the adequate context. But the key is to have an increase in ROIC, and that means that the company is doing better. For the company to not have a decrease in sales, because in Japan, if you decrease your sales, it's very difficult for you to continue to have good results. And to have a ratio which is less than 5 times the free cash flow. This is unbelievable outside of Japan, but in Japan, it's attainable. If we apply the GARP method, and we are quite eclectic, of course, our value approach is something that we do when we search for companies, but if it grows, you cannot compare it with companies that are not growing. So you apply some sort of PIG, and it could be growing annually, and therefore it could be cheaper than others. So the ratio is less than 5 times the free cash flow, and it's not growing so much. Or it has a ratio of less than 1 time the EV free cash flow divided by sales increase, then we can include them. And some of them are increasing, and they increase at 6 to 8 times. So the question is, what will happen when all companies have increased and they are listed at 15 times or 20 times the free cash flow? What should we do then? That's a great question. Should we keep them? Should we maintain them? Because when a market is discovered and it's starting to get good results, maybe it's too excessive. So maybe it could go at 30 times or 40 times like the American ones. And then it will be very difficult to make our choices. Well, we'll cross that bridge whenever we get there, right? What capacity do you think the fund has? Is it concentrated in 38 companies, 50 companies perhaps at the most? But there are small companies, so what capacity is there for this fund? Well, setting a specific number is too daring currently, but it's something that we really focus on. Since the very first day, we focused on liquidity. Ever since we determined that we were going to dive into the small caps, as Marc describes it, we knew that we had to keep tight control. But currently, we're very reassured because in spite of the size and volume that we are currently managing now, there are no problems. But we will cross that bridge when we get there. And of course, this is essential for managers. But it will depend on the second wave of companies. With these 38, we can more than double our current equity. But how much do you have? Right now, it's 21 million. But if in the second wave, out of these 200 companies that have been selected as the best, they are not 200 companies that are more or less interesting. These are companies that have been pre-selected. Well, in the second wave, we will do much more, but we are not at the adequate stage. We don't have enough information. Perhaps my angle is not right, but when you talk about selecting, is there a very quantitative approach to it? Do you focus on ratios and so on? Yes, the first filter is quantitative, completely. So when we go from those 200 to 20, then we start getting qualitative. For them to pass a filter, everything has to be translated. We need to read all the annual reports. We need to find hidden assets or liabilities. And all the auditors that we've seen are the big 5, 100% clean audits. This is why we were afraid that there would be some dirty audits and so on, and because they could explain many things. But what we do is to focus on this type of aspects. Thank you very much. There's questions, right, from the floor. There we go. So apparently on the internet we're receiving some questions. And by the way, does the audience want to ask any question? What's the history in free cash flow? Has it ever gone up to 15? Have you managed to decipher this data? Well, that's a very good question, but we had never seen this data about the US because there's a very complex piece of data. You need to do a lot of work on listed companies, on all the listed companies. So we had never seen that. For instance, Nomura publishes that Nikkei is at 20 times. That's Nomura, and that's the only piece of data that we have. But Nikkei, it's 225 stocks. There's about 3,700, and all the ones that we have are not on Nikkei. So we don't have that data. There's a customer that gave us an idea. Those companies that had the 89 and the 1990 crash, we have a presentation of the different companies. All of them behave better than Nikkei then, but obviously they decreased and then they increased. And nobody has that piece of data, but I can tell you that we have been analyzing this ratio across the world and for many years, and less than 15 or 20 times is not something that we see in the US. And if it exists, it's a value trap normally. Or if they exist, it's something very specific. Crescat says that Standard & Poor's is 40 times. I think Europe is 30 times, perhaps 25 to 30 times. So these are actually the ratios that they have in the market currently. But what I mean is, do you think there's a cultural bias in what they think with a ratio of 8, it's too expensive and no one wants to buy then? Well, it's like when they ask us if we think that they're very conservative in Japan, then they never speculate. But in the 90s, they were the best speculators. When there's euphoria, everybody leverages. So I don't really think this is the case. This is very little value and very little fundamental analysis. Everybody does technical analysis. There aren't foreign funds investing in value there. There's very few of them. So everything needs to be built from scratch then. And in Japan, they have a very singular economy, but 21 degrees in Madrid is 21 degrees in Japan. And about the valuations, we need to go to what Marc said. At the end of the day, 20 is a very difficult figure to attain. And actually, the ones that cause movements in the stocks are foreigners. If you see who owns the Japanese assets or the Japanese stocks, you will see that individuals own 20% of stable stocks. And companies own another 20%. And you cannot see investors in companies in Japan that don't invest in other companies. All companies do that. But the ones that have reduced their presence are insurance companies because they lost so much money that they have withdrawn a lot. They have an increasingly lower amount of companies. And the only example that has grown from 15% to 40% is foreigners, actually. So I think ratios are going to be determined by foreigners because they're the ones that are increasing. Wonderful. So now I'm going to give you a question from a user who was following us on the internet. He's very concerned about the demographic evolution of the country. How do you take this into account in your evaluations? Well, there are many risks in Japan, and undoubtedly this is one of them. The Abenomics, the famous Abenomics, is something that we take into account. We do a lot of macro analysis. We don't like Abenomics, but we like some parts of it. Improving corporate governance, having more independent board members, and there is a very clear element. He wants women to enter the work market, the labor market in Japan. They have an unemployment rate of 3%. And many companies have the problem that they cannot find employees. So the rate of employed women is very low, and Abenomics really intends for this to increase because they have a problem with labor force. Demography is not going to change for the time being. The only change is that there's going to be more immigration. Abe passed a decree by which he allowed thousands of Philippines to enter the country by request of many manufacturing companies in Japan. Because if they don't allow for immigration to come in, this will be a negative handicap that will be very slow, but it will be a handicap. But do people from the Philippines speak English? I don't think they speak Japanese. They will speak English, but quite often Japanese people don't speak English, right? Yes, but as Marc said, we like macro, and Japan is quite advanced, and it's a test lab for many. They have already witnessed a decrease in population. The peak in population was reached in 2013 or 14, and they're decreasing. The forecast is that they will lose 40 million people up to 2050. This is unprecedented. So these are new problems that we need to take into account, and that also has to do with the monetary havoc that they have. For 25 years, they have had that recession. This has had social consequences, so it's a lab. And there's a positive aspect too. Through tourism, until 2013, they had 5 million visitors. And last year, they received 26 million visitors. 2 years ago, the increase in expenditure increased by 78% from tourism. So the most tourism that they get comes from China, and that has caused an increase in real estate, because the Chinese see that they go to Tokyo and they can buy real estate at a price which is 20 times cheaper than in China. But tourism will improve in upcoming years, and things will improve also if they accept immigration. I think we have a question from the floor. Impressive. Well, my first question was going to be whether this was all true, but I see that you have proof for it, so I guess the answer is yes. My next question is, based on the information that we have on the new cryptocurrency derived from Bitcoin, and what is the information that you have in and the investors in your fund? What information do you have about the companies that you have? If you don't know what the nutritional information is, to what extent that increase in sales, that increase in ROIC is really a useful piece of information? Well, the balances and the annual report of the companies give you very interesting information. They're very transparent, the Japanese. The annual reports always follow the same order. This is very helpful for our analytical purposes. But we have information that helps us rank them 7 or 8 over 10. And in European companies of this size, you wouldn't have more than 7. But what we don't have is sector information. We don't have market shares. We don't know who the competitors really are, because they normally do similar things, but you don't have clear information about that. You can access websites, and everything is in Japanese. English web pages are terribly translated, and you cannot find any information, valuable information. So you need to neglect sector information. But with annual reports, we know a lot about workers per divisions, sales per divisions, practically all the information. But of course, we must accept that we are worse informed than we would be in other areas. Most management companies haven't taken this step because they didn't have all the information, and this has helped. This has caused that they neglect what is there. So, actually, to build on what you said, even though it's been mentioned earlier on, I would like to say that the information that we have is the core information, and it's of very high quality, as Marc said. Not having information about the sector or the competitors is sometimes noise, actually, because it gives you a false sense of reassurance, thinking that you're the expert in the sector, because currently these companies have 68 years of experience, but in the team we have all read Anti-Fragile by Taleb, and we really like the concept of negative life. And what's important here is to read the balance adequately. And as Marc said, knowing that we don't have any negative black swans, that all hidden liabilities are well identified, that all balance lines are being analyzed from the worst case scenario standpoint. And from that basis, you can only have positive black swans, even though you don't know the exact sale figure of the province of Tokyo, or even though you may not know some specifics of the company. So you have the most anti-fragile and robust information about the company, which is the cash flow statement. And I think that's part of the success of the fund, that we have been able to focus our analysis on the core information about the companies. I was thinking about that question too. Actually, I was thinking, what is the reason for brokers to not make sector information available? Because one thing is to know all these different companies, but why don't they get in contact with consultants in the market that could be capable of translating out this information and giving you sector information? Because as Talet said, it's a situation in which you could have an increase in sales of 6%, but if you see someone passing you on the right with a 15% growth and they eliminate you, but then the 5-year time horizon could be too long. So why don't we have information on the sector? We really like Nomura. They do a spectacular sector analysis and they explain the sector very well, but they never go down to the level of the companies that we have in our portfolio, because there's 3,600 companies in the stock market. So normally brokers focus on companies that are 300, 400, 500 in size, and we are way below that. So the analysis that they do is very good, but it's very effortful. And these companies have very negative aspects, which is that they have different divisions that are completely unrelated. Sometimes they have very few workers. You may say, okay, they have 3 workers only, but let's disregard that. But sometimes this company have a division that works on one topic and another division works on a completely different topic, and it seems completely illogical for Westerners, or it's very difficult to know who their competitors are. And we need to improve a lot in that sense, and we have many years ahead of us so that we can improve things that have been flawed until now, and this is perhaps one of the aspects, but we'll see later on. So you try to go for companies that are as simple as possible? Yes, very simple, very boring, undoubtedly. And in Japan, we have found another positive aspect. In Japan, we have found companies that you could consider here in the Western world that are going to be eaten up by a competitor, but they have been serving Toyota or Mitsui or Bayashi for many years, and for a Japanese person to break that relationship is very difficult. So they continue to perform well. It's not like in Europe or in the US, when they get a better offer, they go for the competitor. Well, this is not the case. For instance, Senshu Electric. It's one of the top companies that sells electric lines for telecoms. And in Europe, you would say, okay, this company is going to be eaten up by a competitor, or it would be integrated vertically. But it doesn't happen there because there's historical reasons behind it. And it's a whole different world. Very briefly, I would like to say that about the drops in stocks that don't have interest from brokers. Well, for many years, there have been drops, and brokers do not give sector reports because there's no demand from investors, and actually this is what makes the market attractive. It's as if you were in Thailand and there's many scuba diving schools and many tourist spots, but you try to go to the tourist spot that's barely visited and that's not so comfortable to access or so easy to access. So what we're doing here is to look at something that people are neglecting in a way. most of the money, 4% of the Japanese money, is in investment funds, and very few people invest in our funds, in pension funds, and not many people invest in funds. So sector analysis is not very interesting. Foreigners talk about Fanuc, Toshiba, and so on. So brokers have ceased to do analysis, and there's a virgin land, as we call it in our team. And it's a great virgin land, and whenever it's virgin, you need to cut a lot of branches, and there's dangers, but the certainty margin is amazing, and this is why it's worthwhile, and there's a long road ahead of us. We have many questions from the floor, so I'm going to ask you to be briefer because we are exceeding the time allocated. So 2 quick questions. What do you do with the currency? There's many questions about this. And the next question is that you say this is an environment where they do a lot of technical analysis, but do you know someone who's trying to do what you're doing in Japan? Well, we hedge the currency with futures in Chicago of Euro-Yen with the compensation chamber, the clearance chamber, and therefore there's no risk because European rates are at 0 and we constantly hedge for it. And what was the second question? Is there anyone doing the same as you do in Japan? Well, we saw that Marathon in London, they have a fund, which is a hedge fund type of fund with 6 positions. They matched 2 of ours, and they did takeover bid, and both of us were there, and we wrote them, and they ignored us. They didn't answer. I guess we're too small. But there was a takeover bid, and they were paying at a 2 times multiple. And it was amazing. We said, okay, let's get together, because in Japan, the shareholder rights are higher than anyone else. You can try to explain to a corporate governor said that in Japan, companies are ruled by the general shareholders meeting, not by the board. So with a 2%, you can call for a shareholders meeting. With 2%, you can reject a board member. And if you call for a shareholders meeting and the points in the agenda are approved, then that's something that people abide by. And there's very high shareholder risks there, and this is non-existent in other markets. And we told Marathon to get together with us, and they didn't answer. And the takeover bid was approved. They purchased, and they kept ours, and well, they actually are profiting from this. Amiral is doing quite a few things in Japan. I know that Cobas is doing something too. So we're starting to talk about this. We don't know any fit funds that do this, but perhaps there's some in London. We're not very well acquainted with this. I think nevertheless it's a matter of time that people get their head into the market. I wanted to ask about hedging, and also I wanted to ask whether you use one broker only Nomura. I'd rather not give you that information, because these are companies that you need to be very careful with. So why or how do you keep track of prices? We have discovered that they are the best brokers in the world. That's our experience. We have never had such good experiences, and perhaps we have less experience than Cobas in terms of brokers, so we cannot really compare. But we have never seen a broker that increases so little the price of what we purchase. Actually, sometimes we tell them, listen, you need to push more, because otherwise it'll take us a week to purchase this stock, and at this price it's good to do it in one day. But they're very careful, and we're very happy with this. We don't know if all brokers in Japan are this way, but what we really like. And about growth in the fund, given that you invest in small companies? Do you think you will close the fund at some point? We think that the minimum will be to get to 2-3 times the current equity with the initial 38 positions, but because we have 200 that we are currently analyzing, we don't really know. We don't even know ourselves. We will know in 6 months' time, I think, whenever we analyze these 200 companies and when we see how deep we can go, how good they are, and how far we can get. Are there any other questions from the floor? My question is a bit more macro. What's your opinion about the economic forecast in Japan, taking into account the high levels of debt that they have in a context of low inflation? This is another bad point for Japan. They have the highest public debt in Japan, but the best part about it is that all public debt is financed by the Japanese themselves. And they have so many savings, the Japanese, that apart from having all their public debt, they are the biggest holder of North American bonds. So they have lots of savings. Secondly, just as public debt has grown, there has been a great private deleveraging, non-stop. They have been decreasing the debt of companies and families for many, many years. So the great question is, what will happen with public debt in Japan? I would never invest in public debt in Japan because I really don't know where it's headed to. And we don't know the quantitative easing that they're doing, which is brutal. And we don't really like that the central bank pension funds are investing in ETFs of large companies, because we think that this is intervening artificially with the market. Nobody's buying from ours because they're smaller, they're not in ETF, so we are more comfortable and their growth is natural growth, but we don't like that. But we like the macro part. And you need to consider that Japan has had for many years current account surplus. They have a great unbalance, but they have brutal surpluses on the other side. So it's very difficult to forecast what could happen with macro aspects. I would talk about this at length because I love this, but there is a book by Richard Cook, The Holy Grail of Macroeconomics, and he explains balances in Japan. Even though I'm not a great fan of Richard Cook, this is a great book to understand the context behind this question. We have another question around here, I think. Hello. My question is, do you have material time to do so much studying? Because I don't know, in GESIURIS, you manage other funds or just the one? And then another question is, have you visited the companies physically there on site? And my last question is, have you invested your equity also in the fund, if it's possible to know it, of course? Yes, differently than to the question on brokers, we can answer this question. All our money is there in Japan, but we don't manage just Japan. We also manage Capital SICAV, which is our idea bench, our test lab. And then we have an agriculture and water fund. So it's been very demanding to focus on this. We've managed to work, or we learned to work with very few resources for a long time, and now that we have more resources, based on our previous effort, we can assume what is required now. But we have devoted a lot of time, many hours to this, and we always leverage on our knowledge. If a company is in the agricultural sector and it's cheap and it's Japanese, we buy it for the 3 portfolios. But when a company can be purchased in 2 funds, we purchased for 2 funds. So we leverage on knowledge, and we have a lot of Japanese weight on other portfolios as never before. So in this manner, we harness it. What we analyze for one fund, we apply it for the other 2 funds if it fulfills its requirement. And the visits, yes, well, I could be talking about visits for a long time. I don't think we have time, actually. You have 1 minute. Well, very briefly. We sent the list to our brokers to go and visit the companies, and they said to forget about it because there were no investor relations in any of the companies, and they probably didn't speak English in any of them. But we wouldn't like to leave it at that, and we're very stubborn. We got in contact with a public relations company in Japan. We had conversations with them for 2 months. They gave us a budget, quotation. They explained what we had to do, and when we got to the end, we gave up because first they had to look for someone who knew personally each one of those companies. They cannot just call up the companies as they would here, saying, I'm a public relations company, we want to get to know you. They had to first go and visit each company, and once they got in contact with them, they would tell them that we would visit, and then we would have to hire interpreters to go and visit them. And the problem that we had was that based on the experience of other managers, we knew that because they're foreign, we are foreign, they wouldn't give us any information. In Europe, you can tell many things to companies that you can tell to Japanese because they would feel insulted, and we give up because that would need 4 months worth of work, a lot of money, and we possibly wouldn't get answers to the questions that we consider important. We don't give up. We don't think we want to do this in the long term, but for now it's not the case. But you need to consider how different Japan is. If a minister doesn't pay for his subway ride and he gets caught, they would present their resignation. And we have visited Japan, of course. We have invested our equity, and I've tried to get some of my brothers to invest in this, and some of them are reluctant. They need to sell their bitcoins. Yes, I have a brother who won't let go of his bitcoins, but he won't invest in Japan. Do you have some bitcoins? I do have some bitcoins, but maybe you could have a bitcoin class, actually. That's a good idea. We're going to ask the last few questions from the internet. What's your ideal company? Can you set an example from the portfolio, which is as much detail as you can? An example of the ideal investment. Well, the ideal investment, the ideal company would be that you get paid for purchasing it, that ROIC is above 10% and growing, so it's 10, 12, 13, 14, 15 as years go by, having growth in sales of at least 5% on a yearly basis, not having debt, few pension funds, and many holdings from other companies. And there's quite a few of them that we have found in that says. Yes, and based in Singapore, and Pablo Isla as their CEO. And the example? If you can, of course. Well, we have 5 or 6 companies of this kind. We have Fukuda. It's number 1. It's a construction company. Fukuda Corporation. Maruzen is of that kind too. Now it's listed at 4 or 5 times. Century Electric. These are companies that are very special because of their ratios, not because their business is thrilling. These are very simple, straightforward type of companies. Construction, Hokuda is a machinery for cooking, for kitchens, and the other one is electric cabling, but we've never seen this, their features, ever before in our life. Are there any other questions? Well, I was going to ask you, Andrés, if there was something that you had left unmentioned. Well, I was going to wrap up the session, and I would like to thank our participants. No, but there's one question left. We wanted to ask you about the book that has been more important for you as investors. So we have a section in the Value School, which is the most important book. So I can give you a few names quickly, and then Luis, you give it a go. But for me, I really liked stock market history books. The books of Costolani, André Costolani, are very interesting. And also the book by Gilles Livermore, Reminiscence of a Stock Operator, explains how he invested in the early 1900s and in the 1800s. There were some crashes there, so he explains what happened. And of course, we like Michael Lewis, Big Shorty, I think he said, which is very interesting to understand Wall Street, Big Short, sorry. And we also like David Ahorn as a manager, and his book, Following Some of the People All the Time. That's spectacular. He tells how to find those affordable companies and how he's done with them. Well, one book that came to mind is The Richest Man in Babylon, which is actually one of the first books that I read that made me passionate about savings and reading. And then The Big Short, as Marc said. It doesn't just allow you to get to know the value of finance, but it also gives you a lot of lessons about investor psychology, because there's many people who are very contrary to this, and in spite of everything that they hear, they know how to maintain their positions. And then there's two history books that are not very well known by Neil Ferguson. One is The High Financer, which is about the life of Sigmund Warward, who was an English banker from the 30s. He knew how to manage assets that were outside of balance, and he led the reconstruction of the city in the 80s and 90s. And the two volumes on the biography of Ferguson is very interesting. It allows you to talk about bond markets, the importance of information. Just for you to know, Luis is friends with Niall Ferguson. He's met with him in private, and he's very fortunate. Actually, his last book is not a very financial book, but it's going to be released on the 16th of January in English. And I know that Debate will translate it into Spanish in December 2018. Actually, I'm halfway through it because I got it, and it talks about the dialectics that there are between what's hierarchical. He uses the metaphor of the tower, the state, and then the network, the square. That's his metaphor. And it's a very exciting book. It starts talking about the Illuminati, which is the first decentralized force that confronted the hierarchy, and then he talks about Silicon Valley too. Talks about the history of Silicon Valley. And actually, I've put it aside because of work, but it's a thrilling book, and it helps you see things with a perspective that only history can give you, that distance. Thank you very much. So, Andrés, if you didn't want to say anything else before we say goodbye, I would like to show my gratitude to Marc and Luis, who are not based in Madrid. I know it's been very exciting, and we hope to see you again in the near future. And Andrés, thank you very much for your collaboration, and we really hope to have you with us soon again. Thank you very much.